Thank you to the Farm Bureau for inviting me down here. I understand this is the first one of these, and I'm the first speaker, so I'll try not to bore you too much. Tax at 10 a.m. is not the easiest thing in the world, but I tend to be a little animated and a little over-caffeinated, so my goals today will be to keep this a little hopefully provide you some good information, provide a little bit of time for some feedback. You guys can do some Q&A. Feel free to ask questions during this. I may reserve the right to defer the question till later. I'll have some Q&A time at the end. And also the second goal will be to not spill my coffee in the process. So without further ado, we'll get started. As Samantha noted, I'm an attorney with Foster Garvey PC up in Portland. If you haven't ever heard of that firm, it's literally brand new. We just closed a merger. My old firm's name was Garvey Schubert Bearer, and we just merged with the Foster Pepper firm out of Seattle, and they had the clever idea to let's take the first name of each of the law firms and join them together. So that happened in October 1, but we now have 6 offices around the world, actually: Seattle, Portland, Beijing, DC, New York, and Spokane, and cover the gamut from business advice, business transactions, and litigation. I personally do tax and business planning work and tax controversy work, which is sort of the audits and appeals. I've had a number of these farm-related audits over the years. Many of them focus on this issue of hobby losses that I'll talk to you about today. And they can be big and ugly. So I talked a little bit Samantha about them, and she invited me to come down and talk. So without further ado, and I'll get the commercial over from my firm, and we'll get started. So, and I'm going to keep looking up there out of habit, even though that screen is right there. Today we're going to have a little bit of introduction, sort of some background, and then, let's see if this clicker is working. Try that. There we go. Talk about the hobby loss rules and regulations, and then we're going to talk about, got a real delay here, sorry, demonstrating how you have a business under these rules to make sure that the tax man doesn't come after you. And then talk about, if you get audited, what do you do? And how you defend yourself in the audit. Because hopefully you've done enough that you don't have to hire somebody like me. So, in the beginning, this country has had a long history, and the government, state, local, federal governments have a long history of support for farms and agriculture and agribusinesses. This has manifested itself in everything from price supports, intended to stabilize prices in markets and ensure plentiful food production, to just helping alleviate market swings in prices for consumers as well as producers and sellers of farm products. And farming is a tough business, as you know, dependent on the weather, dependent on trade, dependent on what's going on around the world. If I recall, my grandpa, both grandpas used to farm, and one of them once said to me that, when there's good times here, it usually means somebody else is having a bad year. It's pretty true. And what you've seen in the federal government and in the state and local governments is usually support in terms of the tax code. A little bit different tax framework for things like depreciation, reporting. You get things like farm deferrals for property taxes, and so you see a lot of that. But recently, there's been an uptick in audit activity by the IRS, and more importantly by the Department of Revenue here in Oregon. They've really been focusing on audits of farms and agribusinesses, and especially in this hobby loss area. And it's come to the point where it used to be the hobby loss rules focused on what we used to call gentlemen's farms. Is anybody familiar with that term? So those are the folks, the farms like my father used to have. My father was a town doctor, a small town in Idaho. And growing up, we had some cattle, had some sheep, all of us kids were in 4-H, and he had some llamas, and over the years he grew to have actually a pretty good sized llama ranch. But that was sort of the notion of the gentleman's farm, where people would have these small little side farm operations that weren't really their day job, but because of the tax code, if they were a business, you could take a lot of deductions for them and deduct a heck of a lot of stuff. And stuff that you probably shouldn't necessarily be deducting because you weren't really in the true business of farming. I'll say my father was, just in case anybody from the tax man's listening. But that's what these rules were aimed at. But lately, they've been getting expanded, and targets for farms like sizable operations that you would never have expected them to come after under these rules. And we'll talk a little bit about why. Assuming my PowerPoint slide moves forward. Let's try this. Ah, there we go. Let's click a few of these things and get forward here. Oh, I'm just end up using this one. That'll be easier. Sorry for the technical difficulties here. So first up, let's talk about the rules. Code Section 183, it's Internal Revenue Code Section 183, sets forth the framework of the hobby loss rules. And effectively what it does is it disallows business expense deductions for activities that are not engaged for profit. I'm going to wave my hands and use quotes a lot as well. And it disallows them except to the extent that you have revenues from that activity. So what that means is if you have one of these small hobby farms that you generally don't make much profit, but you may sell some animals, or you may sell some produce, or you may sell some crops every now and then, but they generally probably don't produce enough revenue to cover all your expenses, well, these rules are designed to only let you deduct and have sort of a zero base. You won't be able to take any losses and use those losses to offset other income or offset income in future years. Now, if you're a business and you have a bad year and you have losses, you can carry those losses forward and use them to offset future year profits, or you can use them to offset other income. Maybe you have another source or another business. And so these rules can be very devastating because they can disallow huge amounts of deductions, and you get a giant assessment for income from the tax man. And like with any audit or tax benefit under the code, the taxpayer always bears the burden of proof to show that they qualify to take a deduction. And under the 183 rules, they have to show that there's a basic and dominant motive to earn a profit from this activity. I'm going backwards, sorry. I'll get it figured out. So the Treasury regulations under Code Section 183 set forth a framework for courts and auditors to use to look at interpreting whether or not there's this profit motive, this profit intent in whatever somebody's doing. It doesn't just apply to farms, it applies to anybody. It could be like a craftsman doing some woodworking who likes to make some cabinetry and or furniture and sell that out of his garage. That could be a hobby as well. But we're going to talk about the farm context today. But the regulations set forth a 9-factor test, and we'll go through the 9 factors briefly now and then more detail later. And these factors help the courts and the auditors interpret, is there a profit motive? And the first one is the manner in which the taxpayer conducts the activity. That's pretty straightforward. Are you conducting your activity like a business? Are you going out there having separate books and records? Are you acting like you're trying to earn a profit? Second one is the expertise of the taxpayer and their advisors. Do you have any expertise in this area, or are you just kind of out there doing this for fun? Do you go and get professional advisors, or do you never listen to anyone? Third one, the time and effort spent by the taxpayer in the activity. And this looks at really the notion of, if you're doing this full time, you're probably in it for a profit. If you're doing it just a little bit on the side, it may be more likely to be a hobby. The fourth one is the expectation that assets used in the activity will appreciate in value. This is a big one. I'll talk about it a fair bit later, and it's really important to the farm context because you often have land, which is very valuable and tends to appreciate over time, as well as things like herds and crops and timber for those who may be involved in the timber industry, all appreciating assets. The fifth factor is the success of the taxpayer in carrying on other similar or dissimilar activities. Basically, the notion is, have you done something? Have you had another successful business that you've been involved with? If so, then this is probably a business too. The sixth one is whether or not you have a history of income or losses with respect to the activity. And this is one that gets keyed on, very key factor. We'll discuss in more detail later. The seventh, the amount of occasional profits, if any. Also key. Eighth, financial status of the taxpayer. This kind of looks to whether or not you have additional sources of income or assets that you kind of live off, or is the farming activity or whatever activity is at issue your main source of livelihood. And the ninth one is elements of personal satisfaction or recreation. And this is frankly a great one, and we'll talk about it in a fair bit of detail. But it's one where the auditors often get confused and often will lock onto a fact that's not really favorable to the taxpayer, something they're doing, and that just lock onto it and disregard everything else. And so that's an area that there's often battles when there's audits going on. But with those 9 factors in mind, there's the Treasury regulations also put out several overarching principles for which courts and auditors are supposed to interpret these rules, these 9 factors. And we'll look at all the facts and circumstances of what a taxpayer is doing. And 3 key principles are listed here. The first is that taxpayers are not required to have a reasonable expectation of making a profit. Second is that only an actual and honest objective of making a profit is required. Third, a small chance of making a large profit may be sufficient. Now let's kind of back that all up and unpack it a little bit. In the law more broadly, there's often this notion of the concept of what would a reasonable person do under certain circumstances. And courts always look to that, and juries are often asked to look to that. Here though, the first principle is that taxpayers are not required to be reasonable in their expectation of making a profit out of what they're doing. So you can actually be unreasonable in what you're doing, and where to the extent where a reasonable business person wouldn't be doing it. A taxpayer is only required to just, from a subjective personal standpoint, have an honest motive that they think they can make a profit, and that includes a small chance of making a large profit. So that is kind of a speculative notion. And there's an example in the regulations of a wildcat oil driller. Anybody know what that is? Yeah. That's somebody who basically, they don't know that there's oil in the ground, they haven't plotted it out, they haven't figured it out, but they're going to go out and get a lease for some land to be able to drill oil under it. And then they're going to go sink a whole lot of money into the ground, digging that hole, and hope to find that oil. And 9 times out of 10 or 99 times out of 100, it's going to be a dry well. But when that 1 out of 100 hits, it's a gusher. And the regulations say that all you need is to have that unreasonable notion of going out there and taking that 1 in 100 chance of finding that gusher, and you're okay under these rules. Problem is, auditors often disregard this and look to say, hey, you've got a series of losses here, it doesn't look like you're ever going to make a profit, this is totally unreasonable. A reasonable business person would shut down. And so that's where the battle often is. Now we'll kind of go into the factors in a little more detail. So the first one, manner in which the taxpayer conducts the activity. First up, important to have a business plan. It doesn't have to be written, but it's good to have a plan. I'll talk a little bit more about what the contents of that might be later. Second, important to maintain business records and separate records from your personal finances. A lot of people, often small business owners tend to blend things. Try to keep a separate set of books, and maybe work with a bookkeeper or your accountant to have a separate set of books. Separate bank accounts, very helpful as well. And overshot one there. And advertising. Advertising is a important means of showing you're in a business. If you're not doing advertising, you probably aren't really thinking about making a whole lot of profit out of it. So those are key aspects of that factor. Second one is the expertise of the taxpayer and their advisors. Do you actually go out and consult experts, or whether you hire them or whether you just informally talk to people? Who do you talk to? Are they experts in the field? For example, experts in, if somebody's in the horse industry, experts in a particular breed, or cattle industry, particular breed of cattle. Is it somebody who's recognized as knowing what they're doing in the field? But you also can consult financial experts and business experts. Do you consult with a CPA or business attorney on things you might do to improve your business? Do you follow the advice? It's very important. If you go seek advice and you don't follow it, it often doesn't look like you're wanting to make a profit or wanting to improve. And that's something that auditors will just get hung up on. So if you seek advice, it's always good to try and follow it. Secondly, are you trying to educate yourselves? It can be formal studies, such as going to conferences such as this, college courses, something else, something that helps you improve your agribusiness, but also the business itself. An informal study also works. You just go out and talk to, somebody who's successful in doing what they're doing at maybe a conference and learn what they do, talk and shop a little bit. Key in all this is, though, not just focusing on improving your herd or improving the product you're producing, but focus on improving the business and the profitability aspect of it. Improving yields, improving revenues, reducing costs. That's something that is a key focus. Third, time and effort spent by the taxpayer in the activity. Like I said earlier, the more time you spend in the activity, the more likely it is to be favorable, that it shows that you're in it for a profit. Most people don't spend a lot of time, doing things 12-hour days if they're not trying to make money doing it. There may be some crazy people, but who knows? Fourth, I'll talk about this one for a fair bit. It's the expectation that the assets of the activity may appreciate in value. And I've got the cut timber there. My assistant found me a nice picture of that. And the key here is in the farm agribusiness sector. You've got land, you've got timber, you've got herds. If you're in like the hazelnut business, you've got the trees. They appreciate in value over time as they're growing, and the yields can get better, at least to a certain point. So there's appreciating assets. And the important factor here is that there's really two types of business activities you can be conducting in a farm business where, well, there are multiple types, but two sources of profits, right? There's your operating profits from the activities you're doing. Maybe you're ranching, or you're raising wheat, or you're, raising grapes. And there's also and that could be, an annual, profits or annual losses, depending on how things are doing from year to year. So it's kind of the operating business. And then there's the notion that the assets you own, or the assets you use, may also be appreciating in value. Your herd size may be growing if you're a rancher. Market prices may be going up, which brings up, the value as well. Land generally appreciates over time. You can be sitting on a really valuable appreciating asset. Timber, it always gets more valuable as it grows, assuming it keeps growing. And so if you have two separate activities, and one is you've always got this appreciation, and this other one you may have profits, may have losses, may have several years of losses, but the notion is you've also got this appreciating asset over here, and you combine them, then overall these potential profits may offset any potential losses here for a notion of proving, are you making profits? And auditors get hung up on this notion a fair bit. But the rules allow taxpayers to group various activities in a myriad of ways and are favorable to them. They're basically, except for a few circumstances, taxpayers are allowed to group various activities, land holding and farm operations, together for purposes of saying, am I making a profit? And so these appreciating assets can be very helpful in making a case. There is a specific regulation, though, a specific exception to the ability to group assets together that applies to farming businesses, though. And it's not really that great, but the opposite of it is really good. The rule is, if land is held primarily to profit from the appreciation and not for the farming operations, then the farming activity and the landholding activity can be combined into a single activity only if the farming activity is by itself profitable, so that it reduces the carrying cost of owning the land. And that kind of makes sense if you unpack it a little bit. So the notion is, if you're buying the land for its appreciating in value, and you're just going to hold it, and maybe the airport's going to expand and buy you out someday, and you're going to cash in, then and you're just sort of farming on it on the side to cover your costs in the meantime, then really this farm operation needs to be profitable to make sure you actually are covering the cost, the property taxes, the maintenance and such. If it's not profitable, then they're not going to let you lump them together. However, the converse of this rule is especially helpful to farmers. If you purchase and own land primarily for farming, and the potential profit from the appreciation is secondary, the land ownership and the farming operations can be grouped. The IRS or Department of Revenue can't say you can't group them. And this makes it a much easier test, as I was telling you. Basically, if you have a series of losses over here in your operating business, the potential appreciation can offset that and actually show a long-term profit. And often you have to get into these nitty-gritty details if there's an audit. Any questions? Am I making sense? Slow down? Okay. This factor, success of a taxpayer with similar or dissimilar activities, this is one that's not as important as it used to be. A lot of courts lately have said this is of more minor importance, and even the tax authorities don't pay as much attention to it, although sometimes you get an auditor hung up on it. But the notion is that if you have previously had a successful business, or you have another one, or you maybe took a business and turned it around and made it profitable, then probably what you're doing in this activity in question is also you're intended to have a profit. Kind of gives you the benefit of the doubt. Of course, the converse would be true. If you're really bad at business in another business and you do farming, why does that make you have a profit motive? That's not very helpful. But courts have come out and said that fundamentally different activities in comparing them aren't really helpful in aiding any kind of determination as to whether you have a profit motive. And so, like, if you're an attorney and you own a llama farm on the side, those are so different that it really doesn't matter if you're successful or not as an attorney as to whether or not you're intending to make profits from your llamas. And similarly, an important helpful note the courts have said is that lack of experience in the particular field in question doesn't necessarily weigh against you. And I've had auditors say, hey, you haven't ever had any experience before you went into farming at age 18. How did that, when you haven't made any profits for a while, I assume this is just a hobby for you. Like, literally, that's what they say. Well, when you're 18, you don't have often a lot of experience other than farming when you grew up on the farm as a kid, or doing what you're doing. So that's why courts have often poo-pooed this factor a little bit. This one's the big one. Taxpayers' history of income or losses regarding an activity. And this is the giant red flag that auditors have, because when the IRS or the Department of Revenue pulls your return for audit, what do? Well, they have a computer and they look through all the years, and they have a computer system to look through all the years of your past filing history. They see all your Schedule C's, all your Schedule F's, and they can just say, oh, at the bottom, was there a profit or loss in any of these? If there's too many years where there's losses or nominal profit, oh, we're going to pull you for an audit. That's what they do. So that's how a lot of these come up. You get a couple years of losses in a row, you may be on the hook for an audit in the near future. But the big issue with this factor is the notion of a startup period. Anybody familiar with the startup period for business? Yeah. See a few hands going up. The notion is that when you first start a business, it may take a little while to become profitable, start a new activity. So you go out, you want to open a bake shop, sell some sticky buns or something, or some really good donuts. And so what do? You first get some recipes, you get a lease a storefront, go buy an oven, some equipment, hire a few employees, maybe get a name, put an ad in the paper, say, hey, we're open for business, and then you wait for customers, right? And then you hope those customers will come back. And it can take a while to get that repeat business off the ground. And often, businesses, it's a known fact that businesses often take several years of losses before they can actually make a profit. That's the startup period. And in the agribusiness sector, the startup periods are traditionally longer. And because of the vagaries and the variances in weather and production and everything else that affects the sector, it can be many years until you have a profitable operation, as for example, herd size grows. You start out as a cattle rancher, maybe get 20 head of cattle initially, and then you raise some and you sell off a few culls, and then you keep the best ones and raise those and keep going. At least that's what we did in the llama business. But it takes a while for your herd size to grow. Same with like timber operations, that sort of thing. Startup periods are key, and the notion with the startup period is that it can apply to a particular activity you're doing, or it can apply to a new activity, or it can apply to a change in your existing activity. So it's important to document changes when you make them, so that if you're ever looked at, you can say, hey, no, this isn't a startup period. And I'll explain a little bit. Say you're a cattle ranger, and you've just been raising, say, Angus beef, and you sell them at market, at auction, and get market price. And then say you get this whole farm-to-table thing that's become very popular in the Northwest. People want to go to their local restaurant and buy a steak and know where it came from. And so you start raising maybe a different kind of cattle to serve that market, change of breed. And you start marketing to that market, certain restaurants or associations where you can get it in with. And that's a different activity, even though it does relate to your existing cattle ranching operations. And so that's where, if you start that up, it may take several years to actually generate profit from that activity, the new branch. And in the meantime, though, those profits can drag down your overall, those losses can drag down your overall profitability of your remaining operations. Like when you report your activities on Schedule F, it's all lumped together. It doesn't say, this cattle and that cattle. It's all one operation usually. And so you could actually have new operations and the startup losses from there drag down your other ones, and the auditor is just looking at the combined basis. And so it's important to say, oh, no, this is not a separate operation. It's in a startup period. I'm not expecting it to be profitable for, say, 5 years under my business plan. My other operation is by itself profitable. It's all fine. So that's why these become very important. It's important to document the changes and things you do to improve profits. Along these same lines, external factors can be key in startup periods and just in operations in general, and it's important to document those because things fire, flood, disease, get predators in, market swings, when the market falls out of because of some kind of trade, this or that or the other, or because somebody else decides that beef is bad for you, then that can cause a major, problem in your overall operations. And if you have a planned startup period where you're going 6 years into you're profitable or you're going along fine, these kind of external factors can really put a dent in the bottom line results. And that's what auditors often fail to look at them and take them into account when they're looking at, okay, you got like 3 years of losses or 4 years of losses. Why is that? So, but they're supposed to. Seventh factor is the amount of occasional profits, if any. And this is kind of the notion of what is your business model of your operation. Is it sort of a business model that you're probably going to make regular profits after it's up and running? Or is it a model where you often have sort of regular losses and then you'll have a year where you have big profits, depending on market factors or things? And this may be it's key for maybe certain types of businesses. I had a client who was into horses, thoroughbreds, and he raised race horses, and he trained them. And he got hit for one of these hobby loss audits. But his business model was built around the notion of the big score. He figured he'd race horses every year. He'd train some. If they didn't work out, he'd sell them off quickly. And he was always focusing on that one that was going to be a winner. And the prize winner, and then you get the prize money, and then the value of the animal goes up. You can get stud fees. You can get maybe somebody wanted to buy it for an exorbitant amount. People in that kind of business do that sort of thing. And so he was always looking for the big score. So his business model was, I'm going to lose money probably 4 out of every 5 years or 6 out of every 7. But in that that next year it's going to be a big score, and that was his model. And the speculative nature of certain ventures is okay under the rules. But what happens is, and what I've seen auditors focus on improperly, is whether or not, the question whether or not you have to recoup past losses. So, say for example, you start up your business, and or you start up a new venture, and you have 5-6 years of losses in a row. Maybe you've lost, $300,000. Maybe you've lost a total of $500,000. Substantial amount. Do you have to make all that up and earn an extra $1 to say, oh no, I actually am, profitable in the long run, and so that I'm not a hobby. I can prove I'm a profitable business. The Department of Revenue, especially, and sometimes the IRS, has taken the position that yes, you have to make up every dollar of past losses, which can be really bad if you have a disaster, or a disease, or a fire wipes out your entire timber stand. That can be atrocious. But there's a line of, went too far. There's a line of cases out there that is helpful to taxpayers, and you just got to get auditors to look at it. And this line of cases takes more of a forward-looking approach. They say you don't look at past losses. They say, but for any given year, the year at issue, when you look forward to the time you expect to be profitable, if there's any unprofitable years in there, will your future profit expectations make up for these loss expectations on a go-forward basis, not the past? So if you've had a few bad years, you don't look at that. You look at whether or not in the next year or the next couple years out, when you will be profitable, can you recoup the losses in the interim? And that's much more taxpayer-friendly, much more helpful. Hopefully that makes sense. Eighth factor, financial status of taxpayer. Piggy bank underwater. Notion here is if you have other income, so this is really aimed at the hobby loss farmers, the gentleman's farms. So if you're an attorney with the llama farm or the doctor with the llama farm, having that other income is a negative. It shows you have other resources and that your farm activities are not your main source of livelihood. Similarly, if you're a retiree and you have a pension and you decide you want to go start up a small farm and do the farm to table thing, or you want to start a vineyard and start making some wine, the fact you have that pension income and you're retired from your other job is actually a negative. And auditors really focus in on that. Ninth factor, elements of personal satisfaction or recreation. This is the fun one. Got the equestrian jumper here on the screen. And this one really comes into play with, it's a key factor, and auditors get hung up on it. And it comes into play with certain types of livestock activities, horses being one, and other sorts of prestige activities, winemaking and things like that. But it also will impact people who have family that work on the farm. Anybody have kids who's ever worked on the farm or grew up working on a farm as a kid? Yeah, there you go. Auditors don't really like that. They think you're doing it for personal reasons. They think you have the lifestyle, want to move out to the country and have your kids, show them the value of hard work and help them raise some animals and do 4-H and all that. That's a lifestyle thing. I don't know, my grandpa used to call it free labor. And he had a lot of kids for that reason. But this is where taxpayers will shoot themselves in the foot, either not unintentionally or just they do things that really aren't smart. And I'll give you some examples. I got like 4 sets of examples here, and we can maybe talk about what do you think are these good factors or bad factors. Take a drink of coffee here first. So say you got the physician who owns the horse farm. Dad, mom, 2 daughters. They all love horses. They ride them. Daughters grow up doing 4-H and FFA with the horses. They also have a few animals they breed. They sell some of the horses. They maybe help do some training of other people's animals. So they got a small amount of revenue on the side, but they're taking all the expense deductions. They go to shows, especially around the kids and the 4-H stuff, and every now and then they'll sell the 4-H animals, etc. And at some point the daughters grow up, they go off to college, and mom and dad are getting tired, and let's maybe cut this back or shut it down. And so we just wrap up, we'll sell off the herd and call it good. We'll just focus on something else. I think those are good or bad facts under a scenario like this. I'm going to say they're really not great. They may be in it for the profit motive, but from the vantage point of the auditor who's just looking at this, it really looks like the whole operation was just built around lifestyle, wanting the girls to grow up, having horses, and that's what the family does for fun. And so the fact that that's an easy target for a hobby loss audit. And this factor in particular, they look at in the lens of, with the lens of all the other factors too. What's your experience? Are you acting like a business? Are you not advertising? So on and so forth. So these types of personal elements that come into play really can be damning even in an audit. and make you have to really fight hard. Second scenario, taxpayer owns and raises cattle and horses. There's a lot of, them and the family do a lot of the unpleasant work themselves. So they're out, feeding the animals in the cold and the rain, mucking out stalls, maintaining the fence, the barns, facilities, etc. They attend shows, but they don't necessarily ride the animals in the shows. For like the horses, they have somebody else ride them and knows what they're doing, better rider, etc. And they keep a separate set of animals for pleasure riding. So they have their own separate horses for riding themselves and fun, and their business horses are the ones they take to the shows and sell off. What do you think of those facts? That's a better set of facts. It really shows that they're keeping the pleasure and the business separate. And although they're doing the work themselves, and although they attend some of the shows for maybe some fun and stuff too, there seems to be more of a business notion, and that is a very much better set of facts to work with. Fourth example, taxpayer retires and buys a vineyard. They do a lot of the dirty work themselves, but they hire additional hands as needed during harvest season, etc. And they attend some workshops for growing, marketing, figure out how to make the best Pinot Noir, and keep the plants disease-free, etc. But they don't do a lot of advertising or marketing much. They sell mostly out of the home, have a little website. Actually, I'm not sure if you can do that at the liquor laws, but anyhow, they sell off the vineyard, and they give a lot of wine away to friends and family. They're very proud of their label and what they're doing, and Christmas parties and such. What do you think of those facts? It sounds very personally recreational fun aspects. It's not, those are really bad facts. And I have this is kind of right out of a family friend. They do this sort of thing, and you always get, a bottle of wine at Christmas with their label, and they're very proud of it, and, it's not bad, but I don't know that they go out and market it and sell it, I'm not going to disclose their names. Another set of facts, similar facts. Attorney owns a vineyard. Not me personally, but somebody else. They do a little work personally, or they do very little work personally, because they're busy with their attorney lifestyle and schedule, and they hire most of their workers. They attend classes and events on how to improve the wine they're making, how to get better yields, how to market better. They bottle and sell most of the wine. They do a fair bit of advertising. They work pretty hard at expanding distribution to local stores. And they give minimal wine away, and usually when they do so, it's for marketing purposes. So, school has a fundraiser, auction or something, somebody asks, hey, can you donate a case of wine? They do that for marketing. Good or bad facts? Good. Those are good facts. It does look like a business. It's a second business, effectively, because the guy's a full-time attorney, but it's a business. And everything that it looks like they're doing is for marketing purposes. So, with that in mind, how do you demonstrate you have a business? First, operate in a business-like manner. What does that mean, then? We talked about a business plan earlier. So a business plan can either be written or it can be just up in your head. If you get on it, it's always helpful to have it written down in advance. But normally it encompasses the acquisition of the assets and the equipment, what you're going to do with them, any projected startup period. So this would be like the pre-productive period for as your herd's growing or as your hazelnut trees are growing, etc. Whether or not you're gonna, who you're gonna have as your advisors. You don't necessarily have to know that up front, but if you talk to somebody regularly, write down, this is somebody I talk to, they got a CPA, etc. Whether or not you'll have a business calendar, it'll schedule what types of events you'll attend. For example, this one, to learn more about the business. It'll cover advertising and marketing, and what you're planning to do. You'll have budget projections and a break-even analysis, and this is something where people can work with their accountants on. But those are very important, especially in terms of startup and initial growth. And generally, though, it kind of outlines the steps by which you intend to achieve profitability and maintain profitability, kind of your long-term goals. I'm going to grow my farm till grow my herd till I get to X size, and then we'll just kind of keep it constant, that type of thing.
Excuse me.
Yes.
It sounds like keeping that updated each year would be good, so that 5 years later, 4 years later, you're not, yeah, what happened to the billboards that year? I don't remember why we lost money or.
Perfect question, and you already have the answer.
Okay.
I often recommend people sit down with their business or tax.
Could you repeat her question?
Oh, thank you. I forgot to repeat that. The question was, it sounds like you may want to sit down annually and update a business plan. And the answer is yes. I usually recommend people sit down with, once a year, they're kind of, going over the books, maybe preparing for tax time with their accountant and kind of go over things, maybe update it if you got a business attorney talking about that. Or if you just, do it with, the family and anybody else who's helping manage the business type of thing. But it's good to have it updated because then, A, it shows you got one, and B, it's up to date if you ever get a question. Have a business calendar. Have a separate budget and maintain separate records for your business from your home. Have a business calendar. If you have livestock, have what I just call it an ownership plan, which is sort of the notion of, I'm going to raise livestock till they, I'm breeding them and they're born and then they mature to a certain age and then I sell them off. Kind of the notion of when you're going to sell them off, certain age, certain weight. If it's horses or something you're going to train, how you train them, when you're going to sell them if they're not working out, or if they are working out as trained, just that type of thing. And then keep health records and logs of these types of activities and the plan. Again, hire professional advisors and seek out expertise, especially in the areas of operations and how to improve profitability. Again, it can be an industry professional or somebody else who's really good at what they do. It doesn't need to be a paid attorney or paid accountant. Follow the expert's advice, as I mentioned earlier, and then sit down, kind of that once a year thing, and analyze your expenses and operations, modify the activities over time, and with a sole aim, or not the sole aim, but a key aim to reduce expenses and improve profits. And the notion of if something's not working over a number of years and it continues to be unprofitable, if you don't change it or don't do things to change it, auditors just lock into that and say this is a hobby. It doesn't even matter what it is, honestly. You can have 600 acres and hundreds of livestock in your herd, and you just haven't been profitable. And if you haven't done things to change the lack of profitability, it's bad. So sit down and try to do it, and try to figure out ways to improve it. Again, know your business model. Is it a recurring type of profits, kind of regular profits, or is it sort of one that's more the big score notion, like that thoroughbred owner that I had as a client? And when you have operational changes, this is key, document what you're doing, why, and kind of the projected startup periods. Yes, question?
How do you document? I mean, what does it take to be documented?
That's a really good question. The question is, how do you document? What does that mean? What does it take to do it? Really, it doesn't have to be anything fancy or formal. You can just literally make notes on a paper that says, as part of your plan, things aren't going well. I've, lost $40,000 in this, part of my farm business last year. I'm going to try to maybe scale up my herd a little more to where I can get to a larger scale, so will be profitable to, a larger herd size. And it may be simple just putting that down on paper with a plan that I'm going to scale up to, get 50% larger in the next 3 years. Putting that on paper, with a date, that sort of contemporaneous record is gold if you're somebody like me who has to go defend an audit. So that can be very helpful. Plus, it gives you a roadmap for, this is my plan. Yes?
I had a 1,500 trees, old trees that I bought.
Okay.
Turned around and bought 1,800 new fruit trees. Does the bill for the 1,300 for the new trees and the bill for the excavating the old trees, does that count as proof?
Yes. So if I understood your question correctly, to repeat it, the question is if I had a bunch of one type of tree and I basically bulldozed them under, replaced them with a bunch of new trees, fruit trees of a different type, or just new ones because the old ones were not productive anymore. Does the bill showing that count as proof? Yes, that's good evidence. and if you put a note on it, this is what I did, you know, we did this because, just as helpful. The tough thing is at the end of the day is you know, small business owners, the last thing they ever think about doing when they're tired at night is taking notes of why they did something during the day, right? Like, who wants to do that? But at least every now and then, think about it, or think about it at tax time when you're getting your records ready for your accountant who's doing the taxes. Because then you can say, oh, this was my bill for this, I did this because that, and then put it down at that time. You know, spend an hour just writing out your plan. Yes?
Do you have any tips on just general rule of thumb, like sign, date, make a copy, scan it if you can?
You know, that's a good question. So, question is rule of thumb or any tips on, you know, what you have to do to keep the record. Sign, date, make a copy, scan it in, something like that. And really, you know, the more documentation, the better. But really the key is sort of, are you recording what you're doing that's contemporaneous or, you know, about the same time you're doing it? You're not just preparing it for the audit, because that doesn't look good if all of a sudden you never had any business plan and then you show up, the auditor asks you and says, oh, I'll get one together, and you just put one together and scribble it out. I mean, it can be helpful, but it's not great. And so what I recommend is just any kind of physical evidence or documentation that's sort of about what I'm doing and why around the time you're doing it is helpful. Keep it in your, you know, permanent tax files, keep it in your business plan records, keep it on your computer, you know, scan it in. Any kind of evidence is helpful and better than none. And so that can really go a long ways. Finally, minimize the appearance that recreational aspects surpass the business aspects of your business. You notice the convertible sports car down there. So this all goes to that factor 9, right? The personal recreational aspects. And this is where taxpayers don't always do themselves favors, especially in certain industries. And, you know, I'll reiterate again, key factor, especially with certain types of livestock, any kind of exotic animal or even semi-exotics, llamas, alpacas, you know, yaks, giraffes, I don't know, ostrich, horses, you know, anything with horses, and any other kind of prestige activity, winemaking, something like that, where people like to go to shows and kind of hold themselves out as being, hey, look what I do, you know? When my dad first got into the llama business back in the 80s and I was young, he would go to the shows and there'd be these people who were like very, very wealthy people, like some of the Nordstrom families were into it. The former owner of the Seattle Seahawks was into the business, buying llamas. And some of these folks out there would literally go to the shows, the auctions, and bid each other up for the sole sake of saying, I spent the most money on this animal. That's, you know, those are the kind of shows and activities that really don't look good because they look like there's this element of personal satisfaction, recreation. You're in the biz for the social prestige. And especially these types of things. Winery is another one. You know, what's the old rule? If how to become a millionaire in the winemaking business is start with $2 million. You know, that's why all the Hollywood movie stars and folks get into it. But that's where, if you are in those industries, though, I'm not saying you're not running a business, but you really need to be able to document you are, because you're almost certain to get an attack on the hobby loss aspects. So when you go to these shows or you go to these events, document the business reasons, not just, you know, everybody's going, well, I'm going to go market and hobnob and, you know, talk and make some connections. Okay, so guys are going to know who you went to talk to. Who did you talk to? Did you take them out to dinner, or did you sort of have a casual conversation over a beer? Do they even know who you are if you called them up? That kind of thing. You know, if you have I'm going to go and meet this person and talk to them about X. That's the kind of documentation you want when you're at this type of business. Similarly, avoid the lifestyle extravagances that may be associated with some of these prestige businesses. I mean, the classics are, when my dad was back in the llama business, you'd see people show up in horses or nothing in these events with these giant trailers that are longer than semis, filled with horses. They got TVs in the trailer. I'm not sure if that's for the horses or for the hands. You know, they're getting pulled by these giant rigs or, you know, $500,000 motorhomes, and it's a fun event, and we all need this. And then we got back home, we got the giant barn and the, you know, white picket fence and all that. Trust me, your auditor will not be showing up to the audit in a Cadillac Escalade. So seeing that kind of thing on a depreciation schedule, not helpful to your case. Much better to show up in that 10-year-old Chevy half-ton or full-ton and a little bit banged up trailer. You know what I mean? So beware. Separately, when your family's in the business, this is one taxpayers often don't think about, but don't just have them do the fun activities, like if you're raising the kids, like have them get their hands dirty. I'm sure most of the folks here do. But a key aspect is when you have like the FFA and the 4-H animals and stuff, keep those separate from your other animals, from your business animals, and don't try to like depreciate them or write off the expenses. I mean, maybe you got 5 4-H animals and 50 other livestock animals. Well, they all eat the same hay, right? But your accountant can help you figure out, okay, 5 out of a total of 55, you just do the math, we'll write off, what is that, 90% of the hay. You won't take the 10% that you fed to these animals. You won't run the personal animals vet bills through, that kind of thing. And that often happens though, just accidentally as you're keeping your own records. But if you do get an audit, it's helpful to bring that out up front to the auditor saying, hey, we had this intermingling here, we're going to take out the personal stuff, be up front. That goes a long ways. So audits, what happens when you get audited? Involve your accountant right away. Involve a tax attorney later if you need to, but get them involved at the outset so that they're helpful in responding, helpful in gathering records, helpful in helping you answer the questions that are going to get asked. You always need to answer truthfully, provide the information, but there are ways you can frame the answers that are more favorable than others. That's what I do for a living. Gather your records and keep them, and so it's helpful if you've been keeping them all along. But say you get audited for, like, say, tax year 2016 or 2017, or both. Well, depending on the circumstances, if it's a farm audit or a hobby audit, often, and there's a series of losses involved, the auditors going to want to look back to the years until you last turned a profit. So if you hadn't had a profit in 6 years, you may need to go back to 2012 and have your records from there to show everything in the interim. That doesn't mean they can actually go back and make their adjustments to those years. But that means they're going to look at that for purposes of, during this whole loss-making period, did you or did you not have a profit motive? Because if you don't, then we're going to disallow your deductions in the years under audit, and maybe going forward. And I've had some taxpayers had that situation. They got a bill for $1 million, bill for your $800,000 of additional income, and shut them down. So that's the kind of things that you need to be ready for. Be prepared to substantiate all your deductions. This is where separating out the personal from the business up front is important. If you have personal activities, show that they are separate and you haven't put them in with your business. And if you have a history of losses or are in a prestige business, just be ready for a hobby loss attack. Talk to your CPA up front about the issue, whether or not you think there's a potential. Even talk to your CPA now, like if you've got several years of losses, like is there anything do I have to be worried about a hobby loss issue here, and is there anything we can be doing to help support my position that what I'm doing is not a hobby? And then if you're in these industries, be ready to show your business plan, things you've done to change your operations to minimize losses, improve profitability. And if there's been unforeseen setbacks, fire, disease, floods, etc., depressed market conditions, document those. That can be very helpful. I mean, sometimes, when there's a depressed market, you go out on the internet and find out, oh yeah, this was from X year to Y year, the wheat prices were that bad, or soybeans plummeted because of, something going on around the world. But, document these things, because sometimes you may not remember them later to point out that this was a key thing that caused all these losses in a particular year. Yes?
From case law, do you have a list of prestige businesses?
I just kind of make those up, and that's kind of my term, but those are ones that get focused on. Things where there's exotic animals or atypical livestock. I mean, cattle, sheep businesses are pretty traditional. Normal, raising most crops type of thing. When you get into unusual animals, unusual crops, or activities where there's just this social prestige surrounding it, anything with horses, like equestrian, or even, whether it's Arabian show horses, thoroughbreds, or even just Western horses, if you're going out and doing like horses for rodeo use, right? That could be a prestige business.
How about crops?
Crops, probably a little more typical. I don't know to the extent that there's any sort of problem crop, at least it's I've had experience with. But wineries would be the key one. I mean, grapes and wineries probably. Maybe something that's, you know, unusual for the area. Maybe you're trying to, you know, be the first person to grow a particular crop in this part of Oregon or in this part of the country. That may be something. Or if it's a real small scale. The small scale farms kind of, I mean, if you got thousands of acres, you're probably going to be considered a non-hobby. But if you're there's sort of these medium scale, small scale farms, especially ones that focus on like the farm to table and such, certain niche markets can be ripe for attack.
And that acre sizes range?
You know, it used to be anybody who had like, I'd say a reasonable number of acres, you know, 1,000 acres, 500 acres that you're doing something with, that's a fair bit of investment that you're doing it, you know. It would be unreasonable to be doing it just as a hobby. If you're doing it a hobby, you're on a smaller scale, right? You're not going to have 800 head of cattle as a hobby. You might have 30 or 40, right? But auditors don't necessarily look at it that way. It's sometimes you got to, like, you know, reality check with them when you're talking to them. But there's not a real hard and fast rule of thumb, I guess. Yes, the back.
Losses are due to depreciation expenses. Is that included?
I didn't hear the last part of your question.
If your losses are simply due to the depreciation expense line, does that figure into the auditor's calculations at all?
Yes, the question is if your losses are simply due to depreciation, does that figure into the calculation? The answer is yes. Because technically, it is in the long run an economic diminution in value. And so if you can take it as a tax loss, it'll factor in. So large depreciation or writing off you know, large amounts of equipment right away, that type of thing can play into these audits. Another question, you're up here in the front.
Do you see any change with all the new hemp growers and audits?
That's actually a good question. The question is whether you see any change in the hemp growers and audits. It's pretty new. Audits often take place several years after the fact, so you got to report your taxes and then they pull them for audits several years later. The cannabis industry is its own beastie, and I haven't actually been involved in audits yet of that didn't involve the 263, expense disallowance for cannabis, because it's technically illegal in federal law. But in the hemp business, may be a little different because it's separate, but it could be potentially considered an exotic crop that may be an area where that could have some, you know, audit focus later on. I don't know. That's a good question.
So I'm kind of hung up on number 4, kind of bouncing off his question. Expectation that assets appreciate, and what I really see is more of a you know, we buy all of the seed and the fertilizer that goes in the ground and the crop's sold. Okay, that's gone. All of the equipment and all of the supply, everything is all in a depreciation schedule. The land is held by our immediate family that brought people well before the farm business. So I see nothing, maybe I'm missing something, that we can say, well, yes, this is what we have is going to appreciate. I mean, it'd be like starting a restaurant, and you lease the whole facility, you put up the sign, and you process food.
Yeah.
There's nothing going to appreciate in that business.
Yeah, that's a good question to kind of summarize it here. Question is, what if you have a business that you may not actually have much in the way of appreciating assets? So, you know, crops generally get harvested annually, so those aren't appreciating. You may not own the land, or maybe held in a separate entity or by family members. You may actually lease it. Equipment's obviously going to depreciate in value. So what might you have that may appreciate? It often depends on how your assets are held. So say, for example, if the land is held in the same, if the land is held in by the same taxpayer that has the operations, then you'd have an appreciating asset. So that could be, if your operating entity is a corporation, the land may be held in it. Or if it's an S corporation or a partnership that you have the pass-through taxation that ends up on your own personal return, even if you hold the land personally, you can say that that's involved in the farming there because it's on your personal return and such. You'd only really see a problem where you may have a C corporation as the operating business and you hold the land personally and then lease it to the C Corp, then the C Corp doesn't really have a appreciating asset. But you know, you can still make the argument that if your personal returns audit, because often for farming businesses, they'll open them out of both the corporation and the personal return the same year. You can say, hey, this is just how I've structured my business, but really I am a single, you know, taxpayer that has these activities that are integrated and should be considered integrated. So even if the C Corp has losses in this year, you know, I've got this appreciating asset, the land is that I personally own, that you know, could, when they're joined together or grouped together, able to show a long run profit potential.
So I can imagine a lot of people sitting here thinking, boy, my operation is absolutely no question that it's a business, not a hobby. You've defended cases where I think people will be surprised to see with the Department of Revenue how they've been viewed. Can you talk a little bit about some features of those cases?
Yeah, I've had a number of hobby loss cases over the years, and for a while they were at the IRS level, but the Department of Revenue has ramped up. Most of my IRS ones have involved sort of the prestige businesses, a lot of horses, some alpaca farms, winery. The other ones, the Department of Revenue ones as of late though, they've involved taxpayers with, you know, 800 acres of land, and they grow their own hay to feed to their herd of cattle, herd of sheep, and they got some timber. And their herd's sizable enough that you wouldn't expect that they're in it, you know, just for fun. Like, there's a lot of work to do, and of course the whole family's involved in the business, so that can be good and bad. But they don't live high on the hog. They don't have a lavish lifestyle. They have, you know, 15-year-old pickup trucks and they buy old used tractors. And the auditor looks at it and says, well, you haven't made money since, you know, year X. It's been a while. This has to be a lifestyle thing. Your kids were involved in the business for a long time. It's a lifestyle thing. So I'm going to disallow all your expense deductions for the past, you know, 4 years, and going forward, you can't take any of these deductions other than to the extent of revenue. And hands them a bill for an assessment that says, well, you know, 6 figures of additional income, and high 6 figures. You know, it would basically shut them down. And you go to an appeal within the Department of Revenue, and the appeals officer rubber stamps it. And oh, by the way, the auditor's gotten at least 2 aspects of the law totally wrong in their summary of everything. And so you have to go off to tax court. Regardless of whether you win or lose, you know, in those situations, it is extremely time consuming, extremely expensive from the standpoint of having to hire an attorney or CPA or both to defend you. And because these audits are very facts and circumstances based, they look at all these factors, and you got to look at what your past is and what your plans are to try and see, oh, is there this profit motive? It takes a lot of time to just gather the facts, put them together, package them up in a way that you would think a reasonable auditor would say, hey, you know, this person is in this for the business. But there are, I will say, poorly trained auditors out there who just are looking at every taxpayer as a source of revenue. And not to disparage the state, but the state doesn't have the best trained auditors. Hopefully nobody hears from the state. So something you can do actually is, the best thing that usually happens is, from a tax practitioner standpoint, is when you get in front of somebody who knows what they're doing, a well-trained, well-experienced auditor. Because they're not looking under every rock. They know the key aspects of where to look. And you can talk to them and be reasonable with them. And just from a voter standpoint, funding the government and the taxpayer, you know, the IRS, is a good thing, because it provides them with training for their auditors when they do go out. And some of the worst things that's happened over the years is when there's been the IRS cutbacks because of you know, lack of funding. Because all the senior people retire, and then they have all these junior people who aren't trained. Same thing with the DOR. Any other questions? If not, I think I'm about time to wrap up. I'll be around afterwards as well. So
Yeah, so we have time for a couple more questions, but see, we've scheduled in that if we're gonna have a break right now, if people need to get coffee or go to the restroom, would you mind hanging out? and
Yeah, I'll be around for a little bit.
Ask questions, moving on, and other folks can take a break. Are you all good with that? Or do you want to do one more?
Yeah, I'm happy to do one more here.
I was just going to follow up on his question about the appreciating assets. So if somebody is leasing 90% or all of their land and they don't own anything, what do they have to
That's
show?
a tougher spot, unless you have a related entity that you're actually leasing it from. But if you're the farmer who leases the vast majority of their productive land, or all of it, you don't really have that ability unless, for example, you have like an increasing value of the herd that's on the land, or the increasing value of the trees that's on the land, and those are your trees, that type of thing. So it's a tougher road to hoe. Okay, thank you very much.
A transition because of death from one family member to another, on top of that, I revamped the whole farm. It has a different outlook. It's not growing processed cherries anymore. Does that make you vulnerable?
Transitions sometimes just show up on paper as numbers, and so that can sometimes be a trigger. But the best thing when you're doing transitions is to talk to your advisors and do some good planning for it, because they'll help you plan in a way that A, will protect you, and B, hopefully be supportable if there's ever an audit. Okay. Thank you.